Hi, welcome to Grand Insights. I'm your host, John Feligno, founder of Grand Life Financial. Today we're going to explore whether an annuity or a lump sum payout is the right choice for your pension plan, as understanding the pros and the cons of each is going to make a significant difference in how your retirement unfolds. So a traditional pension or annuity means that you receive a fixed monthly amount that you're going to get for the rest of your life. An upfront payment or lump sum means that you would receive all the money at once. Typically, that payout is roughly the equivalent to the value of paying you an annuity over the rest of your lifetime. Now, if the lump sum option is offered by your company's plan, it is likely because they have an incentive to get higher cost older employees to retire early, or they want to reduce their administrative expenses and insurance premiums. So with available options, it's important to carefully consider several factors when you're deciding. So a lump sum, you choose what to do with the money now, as opposed to an annuity in which you're going to cede control of when and how much you want to receive. If you don't need the money right away, you still receive the pension payments and therefore you're required to pay income tax on it. Now, if you or your spouse have significant health issues and you don't have enough saved for anticipated medical expenses, then a lump sum payout may be the proper choice for you. If you did elect to take the lump sum, you may be tempted to spend part or even all of it. So there's a 2020 report by the Consumer Finance Protection Bureau that found that retirees with monthly pension income were more likely to maintain their spending levels after 5 years compared to those that chose to take the lump sum. And with a lump sum, you have no guarantee the money is going to last your lifetime. In most cases, these payments or a portion can pass on to your spouse after your death. However, quite often, annuities will not provide benefits to other beneficiaries, such as children, unless you have a period certain option. If the pension is sizable and you expect a remainder after you and your spouse's death, then the lump sum payout may be the better choice. Now, if you retired later in life or you and your spouse anticipate a lower life expectancy, then a lump sum may be the correct option because once you both pass, the pension typically will end. With a lump sum, you may be able to reduce your tax liability if, for instance, you rolled it into an IRA and then you waited until you needed to take your required minimum distribution, which assumes at that time you're in a lower tax bracket. Otherwise, you would typically be paying ordinary income tax, and with a large one-time sum, that could push you into higher tax brackets. With an annuity, you're not concerned with the ups and downs of the market. However, with a lump sum, how you choose to invest based on your risk tolerance and your time horizon, that's going to have a clear impact. Now, if you're advanced in age, the lump sum option is not going to provide the time to weather the big market swings. Although with the annuity, you'll know for certain how much you're going to get each month, inflation is going to continuously erode your spending power, unless there's a cost of living adjustment included, which means the payments will increase due to inflation, something that you would typically see in state and local government pensions. If you believe that the financial stability of the company's future is at risk or it operates in a volatile sector, then you want to take that into consideration. In the case of bankruptcy, there's often protection provided by the Pension Benefit Guaranty Corporation. However, there's limits of the annual amount that they pay. And lastly, in some instances, taking the lump sum can trigger the loss of company-sponsored healthcare coverage. If you have any questions, please email or call me, and feel free to send me questions that we can consider for future topics. Thanks very much for joining.